There is no need to spend money on financial websites. You can get everything for free on Yahoo Finance. I'm going to go through all the screens with you to show you all the information you get. We're going to look at Intel. On the summary page, it gives you high-level information, the stock price at the close of the previous trading day, the stock price at the open of the current trading day. Then you have your bid-ask spreads. The bid is always lower than the ask because when you buy a stock, you want to pay as little as possible. And when you sell a stock, you want to receive as much as possible. The bid-ask spread is only 3 cents. It's usually really small because these stocks are highly traded. In the current trading day, the stock traded between $46.25 and $47.79. In the past 52 weeks, it traded between $43.63 and $68.49. 39 million shares were traded in the current trading day. The market cap is $195 billion. In order to calculate that, you could take the stock price times the shares outstanding. In this section right here, the stats section, we'll see the shares outstanding. Their beta is 0.54. That's the volatility of a stock. For example, if the market went up 10% in a year, then this stock should go up 5% since the beta is about 1/2. And if the market went down 10%, this stock should go down about 5%. They have a really good PE ratio of 9.82. That's market cap over earnings. Earnings is the same as net income. We'll see their net income later in the financial section on the income statement. The EPS, earnings per share, is 486. That's net income over shares outstanding. Another way to calculate the PE ratio, take the stock price divided by the earnings per share. The next time they're going to release earnings is 428. Their forward dividend is 1.46. This is the last dividend payment multiplied by 4. 146 divided by the stock price is 3.06%. That's the dividend yield. The ex-dividend is February 4th. So in order to receive the next dividend, which will be paid on March 1st, you have to buy the stock before February 4th. X means without. So think of it as without dividend. The Analyst 1-year target is $54.40. You can see where the stock price moved in the past day, the past 5 days, the past month, 6 months, year to date, 1 year, 5 years, and all the way back to 1984. If you hit the link full screen, it brings you to this chart. In my Yahoo Finance, it defaults to candlesticks, but you could change that to a line format or area or whatever your preference is. You can also add indicators. You can add the moving average, Bollinger Bands, relative strength index. There's so many options. And you can compare it to other stocks or the index. This line is the S&P 500. So they both start at pretty much the same point. Intel was doing better than the S&P 500. Then the gap closed. Now they're trading pretty similar. You can compare to other companies in the same industry like Nvidia. They all start at the same point and they change by percentage. Nvidia has been performing worse than Intel and the index. We have to skip company outlook because you have to pay for that. I think it's $40 a month. If you click on conversations, you can see what other people are saying about this company or just about anything. Statistics gives you a lot of information. You can see the market cap by quarter for the past 5 quarters. Enterprise value, that's market cap plus net debt. Net debt is debt minus cash. You can see the trailing PE. Since PE is market cap over net income, the trailing PE is the net income for the past 4 quarters. The forward PE is the current quarter net income times 4. The PEG ratio is the PE ratio divided by the earnings per share growth. Then you have your price to sales ratio. The great thing about price to sales is it can't be negative. If a company has negative earnings, that means the PE is negative, and you can't have a negative PE, so the number is meaningless. For a startup company that has negative earnings each year, price to sales could be a good indicator. That's market cap over revenue. Price to book is market cap over book value. Book value is assets minus liabilities on a balance sheet, or equity. Enterprise value over revenue. Enterprise value over EBITDA. EBITDA is earnings before interest, taxes, depreciation, and amortization. Their fiscal year ends 12/25. Most companies have a fiscal year end of 12/31. Some have it at 9/30, 6/30, or 3/31. I'm not too sure why some companies do not have the end date the last day of the quarter. Profit margin is net income over revenue. Operating margin is operating income over revenue. The reason the profit margin is usually lower than the operating margin is because the profit margin takes into account the interest the company pays on its debt and the taxes they pay. Return on assets is net income over assets. It's a company's profitability in relation to their assets. Another way to think about it is how well a company uses its assets to generate a profit. Return on equity is net income over equity. This is their revenue for the trailing 12 months, which will be all of 2021. The revenue per share, which is revenue over shares outstanding. Their shares outstanding are 4.07 billion. Their quarterly revenue growth year over year is 2.8%. You want to compare that to the quarterly revenue growth of companies in the same industry. Also, you can compare it to this company's quarterly revenue growth for the past 8 quarters. Gross profit of 44 billion. That's revenue minus cost of revenue. EBITDA is earnings before interest, taxes, depreciation, and amortization. Net income of 20 billion. Diluted earnings per share is 486. Diluted means if all convertible securities converted to equity. Examples are convertible debt, convertible preferred shares, debentures, warrants, etc. Their quarterly earnings year over year is negative 21%. They have 28 billion of cash on their balance sheet. Total cash per share is 7. That's cash over shares outstanding. They have about 39 billion of debt. Debt to equity ratio is total debt over total equity. 40 is a good number. I like it to be below 100. If it's below 100, that means they have more equity than debt. They have a current ratio of 2.1. That's current assets over current liabilities. Book value per share is 23.44. That's equity on the balance sheet divided by shares outstanding. So if you own 1 share, that means $23 of the balance sheet is due to you. Their operating cash flow in 2021 was $30 billion. That's how much cash the company has remaining after running its day-to-day business. Levered free cash flow is cash flow from operations minus capital expenditures. Unlevered free cash flow is the same number, but you add back the interest the company pays on their debt. We talked about beta already on the summary page. The stock has gone down 24% in the past 52 weeks, while the S&P 500 is up 12%. The 52-week low is 44, the high is 68, and the 50-day moving average is 50.58. If you summed up the last 50 trading days and divided by 50, that would give you the 50-day moving average, and then the 200-day moving average. In the past 3 months, 39 million shares have been traded each day on average. In the past 10 days, that's up to 44 million. All the shares outstanding are on float. That means all shares are available for people to purchase. For example, if the founder of the company owned 1 billion shares, that means 3.07 billion shares will be on float. Low float stocks tend to be more volatile, and it's also an opportunity for a short squeeze. Only 0.07% of the shares are held by insiders. 65% of the shares are held by institutions. It's usually a positive when a company has a high institutional ownership because most stock prices are controlled by institutions. 57 million shares are shorted. The short ratio is the percentage of shares shorted. I'm not too sure why it differs from this percentage. In the prior month, on December 31st, they had 69 million shares shorted. The forward annual dividend is the last dividend payment times 4. The forward yield is the forward dividend payment divided by the stock price. The trailing dividend is a sum of the prior 4 dividend payments. The trailing yield is a trailing dividend divided by the stock price. The payout ratio is the sum of all the dividends they paid in the past 12 months divided by the net income. The company will pay their next dividend on 3/1. If you purchase the stock anytime before February 4th, you would get that dividend. If you purchase the stock on February 4th or later, you will not get the 3/1 dividend. The last stock split was in July 2000, a 2-for-1 split. If you click on historical data, you can look at their stock price as far back as you want. You can easily change the start and end date. It'll show the high, the low, the open, and the close for the stock. Also the trading volume. The adjusted close adjusts for splits. If you click on the drop down, you can see the dividends, and you can go back as far as you want. You can see the stock splits. Since 1990, they did 5 stock splits. No data comes up for capital gain. If you click on the profile link, you can see the company's address, phone number, website, the sector, the industry, how many employees, and also some information about the executives. If you click on financials, you could look at their income statement, balance sheet, and statement of cash flows. You could look at it annually or quarterly. The income statement is also known as the profit or loss statement. In 2021, they had revenue of $79 billion. The cost of revenue was $35 billion. The gross profit is revenue minus cost of revenue of $43 billion. Their operating expenses were $22 billion, operating income $22 billion. They paid $482 million of interest on their debt, $100 million of other income or expenses. An example of this is the gain or loss on the sale of one of their divisions. Then your pre-tax income, your taxes, and the bottom line of the income statement is their net income. Some people call it the profit or earnings. Their diluted net income is the same as their net income. Earnings per share or diluted earnings per share. In 2018, there were 4.6 billion shares outstanding, then 4.4 billion, and in 2020 it was 4.2 billion. The diluted shares was a little over 4.2 billion. Intel reports their operating income on their income statement as $19.5 billion. Yahoo Finance is $22 billion. Because Yahoo Finance only has a limited amount of buckets they could put expenses into. So sometimes the expenses go into cost of revenue when they should go into operating expenses and vice versa. But the revenue in Yahoo Finance and net income in Yahoo Finance always matches the company's. Total expenses is their cost of revenue plus their operating expenses. This is net income from continuing and discontinued operations. Some investors like to look at net income only from continuing operations. And that's down here, which is the same. But if they sold a piece of their business in 2021, that would be part of discontinued operations. And in future years, they wouldn't be getting net income from that part of the business. Normalized net income is net income minus other income and expenses, the $103 million. Interest income is the interest the company received on its investments. Interest expense is the interest they pay on their debt. Net interest income is interest income minus interest expense. EBIT is earnings before interest and taxes. Reconciled cost of revenue is the same as cost of revenue. I'm not exactly sure what this is. Reconciled depreciation is the same as their depreciation. Net income from continuing operations. Total unusual items excluding goodwill. This is everything in other income and expenses. And this number includes goodwill. Since there's no goodwill, it's the same number. When it says goodwill, that means a goodwill impairment. Normalized EBITDA. When it says normalized, it takes the EBITDA minuses the $103 million from other income and expenses. The company saved $8.8 million of taxes. Because this $103 million in other income and expenses, that reduced their net income and saved them in taxes. In 2018, they had to pay an additional $5 million of taxes due to other income and expenses. This is the balance sheet. It's a snapshot at a point in time. You could look at this annually or quarterly. Assets are what the company owns. Liabilities are what the company owes. Equity is due to the shareholders. It's assets minus liabilities. It's the book value of the company. In theory, if the company shut down today and sold all its assets, they would get $168 billion. They would use $73 billion to pay off all their liabilities, and the rest would be due to you, the shareholder. Total capitalization is long-term debt plus equity. Common stock equity is the same as this total equity. Working capital is current assets minus current liabilities. Invested capital is debt plus equity. Tangible book value is equity plus intangible assets. Total debt is long-term plus short-term debt. Net debt is total debt minus cash. This shows us the shares outstanding at the end of each calendar year. Let's look at their statement of cash flows. And this tracks the cash that goes in and out of the company. And you can also look at this quarterly or annually. There's 3 sections to the statement of cash flows: operating, investing, and financing. The operating cash flow section is how much cash the company generates from its operational business, and that was $30 billion. Investing cash flows are how much money the company invests in its business. CapEx is part of investing cash flow, property, plant, and equipment. If the company buys a factory to make semiconductor chips, the cost of that factory goes into investing cash flow. And then it's carried on the balance sheet and depreciated over its useful life. Also, if they acquire another company, that goes into investing cash flow. Or if they sell one of their subsidiaries, the cash inflow goes into investing cash flow. The third section is financing cash flows. If the company adds debt or pays down debt, that goes into this section. If they raise equity or buy back shares, that also goes into this section. And also if the company pays a dividend. The ending cash position is the cash balance on the balance sheet as of 12/31, $4.8 billion. The cash balance on the balance sheet as of 12/31/20 was $5.865 billion. They had a cash outflow of $1 billion in 2021. Change in cash is the sum of operating cash flow, investing cash flow, and financing cash flow. They paid $2.3 billion of taxes. The taxes on the income statement are not the taxes they paid. Those are the taxes calculated according to GAAP accounting, generally accepted accounting principles. GAAP calculates taxes different than the IRS. Whatever the IRS says is the amount they have to pay. The interest they pay in their debt is also different than the income statement. According to the income statement in 2021, they paid $597 million of interest on their debt, but the actual cash that left the company was $545 million. All public companies use accrual accounting. If they used cash accounting, the income statement would have $545 million of interest on their debt. If a business has less than $5 million of revenue, it probably uses cash accounting. If your business has less than $5 million of annual revenue and you carry inventory, then you probably use accrual accounting. CapEx are investments in property, plant, and equipment. They issued $5 billion of debt. They paid down $2.5 billion of debt. They bought back $2.4 billion of their own stock. When a company buys back common stock, it decreases the shares outstanding and it makes your shares more valuable. Free cash flow is cash flow from operations minus capital expenditures. This is the cash that's remaining for the investors. So the company can pay a dividend with this cash, buy back stock, pay down debt, or reinvest back into the business. If you click Analysis, the top part shows Analyst earnings estimates for the first quarter of 2022, the second quarter of 2022, all of 2022, and all of 2023. It also has revenue estimates and also EPS estimates. If you click on this options tab, you can look at all the call options and put options. It gives you many strike prices from 30 up through 70. The strike price for puts is 30 to 66. If you buy a call from 30 to 47.50, it's in blue shading. That means it's in the money. If you buy a put from 48 to 66, then it's also in the money. You could also click on straddle. A straddle is when you buy a call and put with the same expiration and strike price. If you click on this link, holders, you can see the top institutional holders and the top mutual fund holders. The last link is sustainability. It gives us their ESG scores. So I hope you learned something new in this video. Let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.